Good morning, good morning, good morning, good afternoon, wherever you are in this world. Hope you're having a fantastic day or will have a fantastic day. And I just wanted to get into it quickly. This is once again only for educational purposes, not financial advice, et cetera, et cetera, et cetera. Just wanted to go over a little bit something I heard about paying yourself first and how to pay yourself first. And it got me thinking. So it's like you get your check, you pay all your bills, and you save whatever's left over. That's the wrong way to go about it, supposedly, right? Sometimes that's the way it is because of what's going on in the world. But they say, well, you pay yourself first by putting into your 401k or your IRA or whatever. It's like, no, you're just paying it later. Plain and simple. I don't like traditional Roth the traditional IRAs and 401ks. I would rather Roth if do anything because the tax deferred is just a play on the words. You're because like, oh, you're going to be in a smaller tax bracket than you when you were working. That's only the case if you're making, let's say, $500,000 a year, and then you're going to be living off of Social Security and your required minimum distributions. Then yeah, I would see that. But if you're someone like an average person that's making $50,000 to $70,000 a year, I would never ever put into a traditional 401k or Roth IRA because what's going to happen is that you are going to hit the required minimum distributions on those, plus your IRA or your Social Security check that you get coming on there, and then any other supplemental income that you might get if you have to work part-time or whatever else not, that's all counted as income, which raises you to a next tax bracket, which means you will be paying more taxes than you on it than you were when you were working. And also another thing I should just show you guys here quickly. Let's see here, where is it? Quickly a new white. I'm just going to do another whiteboard here. So just a quick thing here. So if I'm just going to use round numbers. I'm just going to make it 25% tax rate, everything like that. All right. So let's say that I'm putting $10,000 a year into my 401k IRA through work. And usually it's traditional. So we're just going to stick with traditional. Let's say, oh, you're deferring the taxes later. It's kind of it's a tax trap in my mind because you're putting now it's so let's just say 25%, right? 25% of 10K a year. What is that? $2,500. And let's say you go, I'm just going to say 30 years. Let's just do the quick math on that. Grab my calculator. So $2,500 times 30, that's $75,000, right? You pay in taxes if you paid taxes right up front. Now, they are saying, second here. So they're saying that I read an article that said that it's on my phone here. Within a couple of years, the tax rates will have to supposedly double before, just so we don't default. The U.S. government does not default on anything. And that's with the recession. That's here. One second, I'm going to put this a little further down here. Sorry. So $75,000. Now, they're saying the tax rate is going to have to double, at least double. So if you're right around 22, 24, you're thinking you're going to be right around the 12% tax bracket when you retire. You might be right at the 24% tax bracket, and you're going to pay the exact same amount of money. So that it's deferred. You're going to pay less in taxes when you retire. You're out. It's not even happening anymore in my mind. So I'm here to plan for the future, make it a certain future. So this is one of the biggest things. So instead of doing this, say $10,000 a year for 30 years, that's going to be, it's $300,000 plus all the market ups and downs. So you don't even know where you're at, but let's just say, I'm just going to say you got 900,000 with all market does great for 30 freaking years, or it goes down, it shoots right back up and you keep making more and more money. So let's just say you have 500,000 to $900,000 in your 401k IRA. All right, let's just do the taxes on this, right? Because this is the amount of taxes you're paying throughout that, through your minimum distributions. You're going to be, you're only paying a little bit. That's what it looks like, but this is in this huge big scheme of things, you are going to be paying quite a bit of money. So let's just say 25%. Oh, I did the math wrong there. I did divided. So times 25%, you're paying $125,000. So at 25%, so 25% over here, you're paying $125,000. That's $50,000 more than that. You're kind of screwed. If we go to the $900,000 times the 25%, $225,000. That's what you're paying for in your taxes on $500,000 to $900,000. That's a lot of money. That's a lot more than what you're paying. Oh, sorry, over here on here. So this is why I say don't trust when it says tax deferred. It's tax procrastination. And it's not, oh, I'm going to be paying, I mean, if it was actually tax deferred, I'm going to be paying taxes on $75,000. No, you're paying taxes plus interest. In my mind, that's how I view it, because I'm paying $50,000 more. Oh, but he's like, oh, it's capital gains tax, this, that, and the other thing is like, yeah, but I would rather stay tax free in the end. So this is one of the biggest things that I don't like about tax deferred plans. It sounds like a great idea, especially with that, oh, you're going to get 3% from your company every single year, or up to 6%, whatever they have for your company, because every single company is different. But I'm putting $10,000 in, they're putting 3% in, so that's a little bit. So that's why I said $500,000 to $900,000. Don't know how the market's going to be, but it can go crash in say 7 years again, and then it has to go back up. I mean, there is a chart that I posted on my Facebook page that literally states or shows you if the market crashes this much, it's going to take you at an average return of 8%. It's going to take you, I think it's 6.6 years before you break even and where you were. When 2008 happened, it was almost 44% difference, and I had to make up a ton of money, and it was like right around 71 to 75% of what it was at the very bottom of the 2008 crash, all the way up to 2019. It was the early 2019 where I hadn't even made my money back. Huge, a huge difference. And this was the very first thing that turned me off to a 401k and IRA. But anyway, I hope this didn't piss you off like it pisses me off as much, I should say. I hope that you guys found it valuable. And I hope that you guys have a fantastic and wonderful day. A lot of love to you. Have a great week. Thanks. Bye.